Hi, I'm Brad Rosley. Thanks for tuning in today. Today, I'm really excited to educate all my listeners and viewers regarding income taxes as they relate to mutual funds. This is especially true when mutual funds are held outside of a 401k or an IRA or a Roth IRA. There are income taxes, actually capital gain taxes, that have to be paid, oftentimes with mutual funds. Last year, 2018, there was a huge problem. That's kind of where I want to talk about right now is the pain that came from owning stock mutual funds in 2018. Three big numbers I want to take a look at for 2018. These are not things you hear about every day in the media. 91%, 86%, and 11%. What do they mean? Well, no one else is talking about these, but I'm going to share this with you because most people do know the concept is not what you make, but it's what you keep. 91% of all U.S. equity means stock, U.S. equity funds last year, 2018, had a negative return. 91% lost money. For those of you that were following it closely, the losses mostly occurred in the fourth quarter of last year. The average fund lost over 5% for the year. So I don't have to state the obvious, but it was a bad year in 2018 for stock market investors. This we're going to call the wound. Okay, now let's talk about the salt in the wound. In 2018, 86% of U.S. stock funds paid out what's called a capital gains distribution. What is that? Well, a capital gains distribution is something that mutual funds have to share with their share owners, you the investor, when they have a distribution. What does that mean? Well, as you might imagine, if you own a mutual fund, they may have 100 different holdings in their portfolio. Each holding has a cost. So if their holding was Apple stock and they bought Apple at $20 a share, and later in the year they sold it for $180 a share, and they might have bought it 10 years ago at $20 a share, and they're sold it in 2018 for $180 a share, they had a massive capital gain on their shares of Apple that they sold. Even though Apple stock, when you bought in, might have been $200 a share and it went down to $180, so you actually lost money. But the position of Apple inside the mutual fund had a huge gain. So when they sold it, they put a capital gains on their books. They did that with every position they have. Every position in a mutual fund, when they sell, they're either selling at a gain or a loss. They add up all the gains, they add up all the losses, and they net the two. And when there's a gain, they are required by rule to pay out approximately 98% of that gain to their shareholders, you. So you lost money in a U.S. equity fund in 2018, and then you got socked with a capital gain distribution. How much of a capital gain distribution? Well, that depends on your fund. There's our third number, 11. 11% was the average capital gain distribution in the United States equity funds in 2018. 11% gain. So you pay tax on 11% gain in 2018, even though you probably lost 5% or more in your mutual fund. We're going to call this the salt being rubbed in the wound. Mutual funds, many of them are not made to be income tax efficient. Obviously, if you have these gains inside of a retirement account, it doesn't matter because the taxes are all deferred. So you're better off having them there. You're better off having them in a health savings account or a 529 college savings account or other types of sheltered investments. But if you are going to have money outside of those retirement accounts and the other ones I just mentioned, which I think you should look to putting them in more tax efficient vehicles, like exchange traded funds, for example, or a tax managed type of an account where the managers are really keeping an eye on their shareholders' taxes. Okay, it's very important that you do that. So let me show you another example on how the tax hit worked in two different markets. In 2017, on a $100,000 investment over here, the stock market, the average stock market made 21% in in 2017, but it had 8%. As you look at the number here, 8% was the average mutual fund capital gain disbursement. So you lost about 2% of your return to tax at 2.3%. So you made your 100 grand grew to 121, but after tax you're down to 118. And again, as we just said earlier, in 2018, you lost money. The average fund lost 5.2%. Then they got hit with an 11% income tax hit. So now your $100,000, if you invested on January 1 of 2018, after the loss on the mutual fund portfolio and after the tax hit, is only worth about $92,000. So the wound was you lost money. The salt in the wound was you had to pay taxes even though you lost money in a bad year. So I really suggest you become tax efficient on your investments. You use wrappers that don't have to pay tax. And if you do have a taxable account, use exchange traded funds, which I have videos on as well and blogs on at bradrosley.com. Check those out and be tax efficient. Remember, it's not what you make, it's what you keep. And please subscribe to my site and the YouTube channel, as I'll be filling you with more and more good financial tips, the same ones I use for my clients. I hope you can benefit from them. I know you can if you follow them. Thanks a lot for listening. Have a great day.